12 noon. Good time to take a check on where we are here at the top of the hour. There's the NASDAQ down about 2%. We did reverse lower. By now, you know the headline that the president says the U.S. is calculating a massive increase of tariffs on China over rare earth. China put those new export controls on them. They escalated the trade fight. So that's where we are.
Now, here's the real question. Was this a calculated strike by China or a defensive response to U.S. pressure? Many analysts believe it's both a strategic warning wrapped in economic policy. By targeting rare earths, Beijing didn't just hit America's supply chain, it hit the symbol of American innovation. It reminded the world that while Silicon Valley may design the chips, China holds the materials that make those chips possible. And that's where the drama truly begins. You can almost feel the tension rising between Washington and Beijing, as if the world's two economic giants are standing on opposite sides of a chessboard, each move heavier than the last. The White House knows it can't afford to look weak, but retaliating risks sending markets into deeper turmoil. So what's the right move? Do you push back harder and risk escalation, or do you negotiate and risk appearing dependent?
The president posted just a short time ago. He said, I was to meet President Xi in 2 weeks at APEC in South Korea, but now there seems to be no reason to do so. He also writes, dependent on what China says about the hostile order that they have just put out, I will be forced, as the president of the United States of America, to financially counter their move. For every element that they have been able to monopolize, we have too. He goes on to threaten massive increases in tariffs here and says that the U.S. administration is considering what its moves might be. So no specific retaliation here yet, Scott. What we've got is a rhetorical firing up of the response from the president, threatening a number of actions, including canceling that summit between Trump and Xi Jinping that was expected to happen in South Korea. We don't know if that.
Now, this wasn't just another political statement. It was a clear signal. America was ready to fight back and fight hard. Tariffs are no small threat. They're economic weapons capable of shaking industries, raising prices, and redrawing trade lines across the globe. And when the world's two biggest economies start pointing those weapons at each other, everyone feels the impact from Wall Street to Main Street, from factories in Detroit to tech labs in Silicon Valley. But here's where it gets more complex. The U.S. already has tariffs on over $300 billion worth of Chinese goods, some as high as 30%. So, when the president talks about a massive increase, what exactly does that mean? Are we talking about doubling those rates? Expanding to new categories like electric vehicles, chips, or batteries? If so, the shockwaves won't just hit China. They'll hit American consumers, too. Prices for electronics, cars, and even household items could spike. Inflation could reignite, and global supply chains, already fragile from years of disruptions, could stretch to their breaking point.
So we're only down 1.3% on this news. That, I think, is encouraging. And I think that is because if you step back, first and foremost, you have to assume that cooler heads will prevail. We have a little bit of time between now and when maybe Xi and Trump will meet. So we've got probably 2 weeks of noise. That's okay. We're looking for opportunities to be buying the noise because of all the things you just said. Better economic growth, decent consumer, AI renaissance, good earnings. Earnings are going to be very good. And the good news is on Tuesday, we start to get earnings. So, and which I think the banks are going to be very strong. And you're looking for opportunities, though. So to only be down 1.3% in the face of all of this, I think that's actually encouraging, and it speaks to people wanting to buy the dip. And I think that they will, and I think they should.
Well, I mean, it's been a pretty quick reversal as you're looking on the screen. Right now, it's 1.5%.
The shock wasn't just about numbers. It was about fear that the trade tensions between the U.S. and China were roaring back to life after months of calm. Stocks most exposed to China, Nvidia, AMD, Broadcom, Micron, took heavy hits. These weren't random companies. They're the backbone of America's tech dominance, the same firms driving the global AI revolution. Suddenly, all that optimism about record earnings and market expansion felt fragile, almost illusory. One tweet, one tariff threat, and the confidence that had fueled Wall Street for months began to crack. Analysts described it perfectly. The markets had become priced for perfection. Investors were riding high on good news. AI breakthroughs, rate cuts, and strong earnings while ignoring the lurking risks of geopolitics and global trade instability. Today's sell-off reminded everyone just how quickly that illusion can shatter. Even a small spark from Beijing or Washington can ignite a firestorm across global markets. But here's where things get even more interesting. Amid the chaos, some saw opportunity. A few bold voices on financial networks called this dip a buying opportunity. Their argument, the fundamentals of the U.S. economy remain strong, with GDP growth above 3%, consumer spending steady, and the Fed's rate cuts poised to stimulate growth. They believe the fear is temporary, and that investors who buy now could profit once the panic fades. But others warn that this optimism might be misplaced, that what we're seeing isn't just a temporary dip, but a warning shot for something much bigger.
You know, maybe we get that in earnings, maybe we don't. But that's been one of the stories there. There's, you know, Morgan Stanley positive on that name. AMD's best week since 2016. You've got the Qualcomm news that Mackenzie Sagalos was talking about earlier, where China opening this antitrust probe there. So there's just a lot of tension bubbling back over the surface as we see today. Rob, you have Qualcomm. Jason does too. I'm just curious, as you think about all this playing out, if, you know, the meeting between the president and President Xi wasn't supposed to be for a couple weeks. So if you get, you know, more rhetoric between the two sides, or at least from this end, what that might mean for the market as it looks ahead to a potential meeting between the two.
You make an important point. What is the breaking of the linkage that we've seen? The linkage between AI CapEx, equity markets, the U.S. consumer, and the U.S. economy. There's a positive and virtuous feedback loop going on. AI capital spend fuels earnings. Earnings fuel positive stock performance. Positive stock performance fuels the large, the wealthiest U.S. consumers that are exposed to the market, and that fuels the economy. So anytime you're going to see something that challenges the break in that link, it specifically challenges it in the areas that have done really well, although Qualcomm has lagged quite a bit because of its exposure to China. You're going to have a situation where you get a dramatic pullback, especially in the names that have participated quite a bit. So I don't think this is broken, but these links will become challenged from time to time. And as long as you think this is still in play, and we certainly do through year end, these pullbacks provide opportunities for investors that want to stay long to get in.